Before this YouTube channel, I built and sold websites. And in that time, I was able to make multiple six figures on a marketplace called Flippa. And that's when I learned the value of dollar cost averaging. There were times when I had a lot of money, and investing all of that at one time really scared me because the market could just go up and down in a day. So I was able to spread it out over 6 months every time I did this. And in doing so, I was pretty much immune to market drops or market increases, and it just wasn't as nervous. Now, even with all that money fully invested, I still every single month use dollar cost averaging because frankly, it's just one of the best investment things that you can do. But don't just take my word for it. In today's video, I'm going to have a conversation with my AI assistant, Tiara, that shows you that by using dollar cost averaging, you can actually make more money in the long run. Here's how that conversation went.
So, what exactly is dollar cost averaging? Dollar cost averaging, or DCA, is just a fancy way of saying investing a fixed amount of money at regular intervals. That's it. No complex math, no crystal ball predictions. Just you, consistently putting money into your investments over a long period of time.
So hopefully this simplifies what DCA is in case you aren't completely familiar with it. And next here, Tiara wanted to show you an example so that you actually see how this can play out in the real world.
Let's break it down with a quick example. Imagine you're a huge fan of Tesla. Instead of dumping all your money into Tesla stock at once, you decide to invest $200 every month, no matter what the stock price is. Some months, Tesla stock might be expensive, so your $200 buys fewer shares. Other months, it might be on sale, and your $200 snags more shares. The key is, you're not trying to time the market or guess what the stock will do next. You're just steadily building your investment over time. Here's why this is so cool. DCA works for everyone. And the best part? You can use DCA for individual stocks, mutual funds, ETFs, or even cryptocurrencies if that's your thing.
I love the point here that DCA can work in any investment type. It's absolutely true. And I use it for index funds and also crypto, but you really can use it in any investment type that you'd like. Next, Tiara wanted to show you how DCA can actually lower the cost per share that you pay per company. Now, she had to do this with an example, but as you'll see, it's pretty crazy how the math works out. So make sure you pay extra close attention here and maybe even write notes if you need to.
Meet Sarah, an amateur investor who decides to invest $100 in Ron's Cookies Inc. every month for 4 months. Here's how it might play out. Month 1, stock price is $20. Sarah's $100 buys 5 shares. Month 2, stock drops to $10. Sarah's $100 buys 10 shares. Month 3, stock jumps to $25. Sarah's $100 buys 4 shares. Month 4, stock settles at $20. Sarah's $100 buys 5 shares. After 4 months, Sarah has 24 shares, and she spent a total of $400. Her average cost per share is $16.67. $400 divided by 24 shares. But here's the kicker. The average stock price over those 4 months was $18.75. So Sarah's average purchase price is lower than the average market price. This is the magic of DCA. When prices are high, you buy fewer shares. When they're low, you scoop up more. Over time, this can potentially lower your average cost per share.
So if you're looking at stocks for a specific company, or you're looking at mutual funds or even index funds, this shows you clearly a situation in which you could get an 11% discount on the shares. But there's more benefits than just the discount, and Tiara wanted to talk about those next.
First up, emotional management. Investing can be an emotional roller coaster, right? By investing regularly, regardless of market conditions, you're less likely to make rash decisions based on fear or FOMO. No more panic selling when the market dips or going all in when it's skyrocketing.
Now you could sit here and say, hey, I'm not one of those people. I am not emotional about the stock market. I'm not one of those. You're lying. I know you're lying. I've done it myself, right? Every single person that is watching this, if you've ever invested, there has been a point in your life when you have opened up your stock, your investment account, and you have opened it up and you look and your stomach, you get that sinking feeling in your stomach. I've been there. I've been there a few times. I know what you're dealing with. It's human nature. It's your livelihood, right? I get it. But here's the thing. When DCA, when you're using this properly and you're sticking to it, you don't get nervous. nervous. You actually get excited because you know, oh my gosh, the market's going down, or oh my gosh, the stock's going down, but it doesn't matter because guess what? I'm still gonna buy it next month anyway, and I'm gonna get it at a discount. Now, the next benefit of DCA may be even more important than this one.
Next, let's talk about risk reduction. Remember our friend Sarah? By spreading her investments over time, she didn't risk putting all her eggs in one basket at the wrong moment. If she had invested all $400 at once in month 2, she'd have 40 shares at $10 each. Sounds great, but what if that was the market bottom? With DCA, she got a mix of prices, smoothing out the volatility.
If you're risk averse like me, which by the way, I think is a great characteristic for any trader, anything you can do to reduce volatility is a big win. And I think that DCA does this very well. Now, there is one more crucial advantage that Tiara wanted to make sure to mention here.
DCA helps you build a habit of regular investing and developing consistency. Once you set up your DCA plan, you're automatically showing up every month. Before you know it, you're flexing those investing muscles without even thinking about it, and maybe get more comfortable with increasing your contributions over time.
Now, if you're a beginner, this is one of the most important things to understand. So just getting in the habit of taking money and investing it every single month, whether it's up or down, doesn't even matter. That in and of itself and building up that habit is a very, very big positive. Now, before we move on from all the positives and talk a little about the negatives, Tiara had one more point that she wanted to share.
Here's a cool bonus. DCA can potentially boost your returns over time. Remember, Sarah's average purchase price was 11.09% lower than the average market price. That's like getting a discount on every share. Over years of investing, especially with compounding principles, those savings can really add up.
Now, if you aren't already aware, anything that is compound interest is a huge win. And dollar cost averaging can do that. It's kind of like the golden ticket. And the reality is the fact that it can do it with a discount, as Tiara's already worked out, is a really, really big deal. So I'm glad she mentioned that. Next, Tiara wanted to talk about some of the concerns or the negatives of dollar cost averaging. So let's make sure we cover that too.
First up, the big one. But what if I miss out on gains by not investing all at once? Sure, if the market only went up, lump sum investing would win. But the market doesn't only go up. DCA helps protect you from the "what if I invested everything right before a crash" scenario.
One of my favorite sayings is time in the market is better than timing the market. So in other words, just don't try to time the market. It's not going to work out. Next is a point that I've heard before and is important to clarify as well.
Someone may think, doesn't DCA mean I'm always buying even when prices are high? Yep, that's true. But here's the thing. Nobody, and I mean nobody, can consistently predict market highs and lows. With DCA, you're buying more shares when prices are low and fewer when they're high. Over time, this is likely to work in your favor.
Now, I like this point a lot because it's almost impossible to buy right at the top or right at the bottom. And dollar cost averaging does a really good job in helping you kind of average everything out. The last point here that Tiara makes is important because it could potentially mean losing out on income. So you're definitely going to want to hear it.
Some investors think, won't I miss out on dividends by not investing everything up front? While it's true you might receive fewer dividends initially, remember that you're potentially buying more shares over time with DCA. More shares equals more dividends in the long run. It's a slow and steady approach to dividend growth.
So yeah, even with dividend stocks, if that's your thing, you still won't be losing out on the gains. And dollar cost averaging is all about long term, so it really does work out for all investments. Here's the thing, very few traders would argue against dollar cost averaging. Generally speaking, most people are, big fans of the entire concept. But there are other investment strategies that you should absolutely avoid. And if you're interested in hearing what those are, you can watch this video right here, or if that doesn't sound like it's that interesting to you, you can check out my most recent video right here. As always, if you enjoyed this video, please give it a like so that YouTube shares it with others. And as always, make sure that you subscribe to unlock financial success one AI chat at a time. Thanks so much for watching.